Funds of funds, often abbreviated as FOFs, represent a distinctive and increasingly popular approach within the investment landscape. They offer a unique structure for portfolio construction, setting them apart from traditional investment vehicles. The core principle of an FOF is its strategy of investing not directly in individual securities, but rather in a diversified portfolio comprised of other mutual funds. This layered approach is fundamental to their design and operation. Consequently, FOFs do not directly hold individual stocks, bonds, or other primary assets. Instead, their holdings consist entirely of shares in other professionally managed funds. This FOF structure provides several compelling benefits for investors. It allows for broad exposure to a wide range of asset classes, encompassing various market segments. Furthermore, FOFs grant access to diverse investment styles and philosophies. This can include growth, value, income, or sector-specific strategies, all within a single investment. They also cover different geographic regions, enabling global diversification without the need for multiple direct investments. This broad reach is a key advantage. All these benefits are achieved with a single investment in the FOF itself. This simplifies the investment process for individuals seeking comprehensive portfolio solutions. One of the most significant advantages of FOFs is the instant diversification they provide. This is achieved by holding a basket of underlying funds, each with its own diversified portfolio. This inherent structure effectively spreads risk across numerous investments. It mitigates the impact of poor performance from any single security or even an entire underlying fund. Such broad diversification significantly reduces the impact of any single fund's poor performance on the overall portfolio. This contributes to a more stable investment experience. FOFs are particularly beneficial for investors with limited capital. They can gain access to a highly diversified portfolio that might otherwise be unattainable with smaller sums. They are also ideal for those seeking to build a diversified portfolio quickly and efficiently. The FOF manager handles the complex task of selecting and managing multiple funds. Another primary advantage is the professional management inherent in FOFs. The FOF managers are specifically responsible for selecting the optimal underlying funds. These managers continuously monitor the performance and suitability of the underlying funds. They ensure the portfolio remains aligned with its stated objectives. They also actively rebalance the underlying funds as needed, adjusting allocations to maintain diversification and respond to market changes. This proactive management is crucial. FOF managers conduct extensive research on potential holdings before inclusion. This rigorous due diligence process is a cornerstone of their strategy. Their research includes a thorough analysis of the historical performance of various funds. They look beyond simple returns to understand consistency and risk-adjusted performance. They also meticulously evaluate the expense ratios of potential underlying funds. This helps control costs within the overall FOF structure. Furthermore, FOF managers assess the management teams of the underlying funds. They consider factors like experience, investment philosophy, and track record. This professional oversight is invaluable for investors lacking the time or expertise for such detailed due diligence. It offloads a significant burden. It also helps navigate the complexities of financial markets, which are constantly evolving. Expert managers can adapt to new challenges and opportunities. Ultimately, this professional management potentially identifies promising investment opportunities that individual investors might overlook. It leverages specialized knowledge. Among the various considerations, the layering of fees stands out as arguably the most significant drawback associated with funds of funds. It directly impacts an investor's net returns. Investors pay fees to the FOF itself for its management and operational expenses. This is the first layer of cost. Additionally, investors also pay the fees charged by each of the underlying funds that the FAF holds. This creates a second layer of expenses. This dual fee structure can result in significantly higher overall expenses compared to investing directly in individual funds or securities. It's a critical point of evaluation. It is therefore crucial to thoroughly examine the expense ratios of both the FAF and its underlying holdings. Understanding these costs is paramount. Investors must understand the total cost of ownership to accurately assess the potential returns. High fees can erode investment gains over time. Another key drawback is the performance dependence of FAFs. Their success is intrinsically linked to the performance of their underlying funds. While FOF managers aim to select high-performing funds, success is never guaranteed. Market conditions and individual fund performance can fluctuate. The FOF's overall performance is essentially a blend of its holdings. This means it rarely outperforms its best underlying funds by a significant margin. This blending effect can often lead to average returns, even if some underlying funds perform exceptionally well. The aggregate performance tends to normalize. In some scenarios, it can even potentially lead to below-average returns if the FOF selection process or market timing is suboptimal. This risk must be acknowledged. A third concern for investors can be the lack of transparency in some FAF structures. While regulations often require disclosure, the level of detail can vary. While FAFs typically disclose their holdings, the frequency of these updates can vary significantly. This can make it challenging to stay fully informed. This limited transparency can make it challenging to fully understand the portfolio's exact composition at any given moment. Changes might not be immediately apparent. It can also obscure the true risk profile of the FOF at any given time. Investors might not have a complete picture of their exposure. In summary, funds of funds offer a compelling value proposition for certain investors. They provide a convenient and efficient way to achieve broad diversification. They also grant access to professional management, leveraging expert knowledge for fund selection and ongoing portfolio adjustments. This simplifies investing for many. However, critical factors for investors to consider include the presence of higher fees due to the layered structure. These costs can impact long-term returns. Investors must also acknowledge the dependence on underlying fund performance. The FOF's success is directly tied to the performance of its chosen components. Finally, the potential for limited transparency regarding underlying holdings should be weighed. Understanding what you own is always important. Given these considerations, essential investor actions include conducting thorough research before investing in any FOF. Due diligence is key. It is vital to develop a clear understanding of the FOF's specific investment strategy and objectives. Ensure it aligns with your financial philosophy. Investors must determine if the FOF aligns with their personal financial goals. This includes both short-term and long-term aspirations. Finally, assess if the FOF matches individual risk tolerance. A clear understanding of potential volatility and downside protection is crucial for comfort and success.